Millions of people think they own silver. They see the price go up, they watch their account balance rise, and they feel like silver investors. But here is a question most of them have never been asked. If you needed to hold your silver in your hands tomorrow, could you? For most people who own silver through an ETF like SLV, the honest answer is no. And understanding why that matters, and when it matters most, is exactly what this video is about. Welcome to Money Simplified. Today we are breaking down one of the most misunderstood topics in the entire precious metal space: the difference between real, physical silver and paper silver. We are going to explain exactly what you own when you buy SLV, what you own when you buy PSLV, and what you own when you buy a physical silver bar or coin. We are going to walk through the real risks of each, not the simplified version, the actual fine print. And we are going to show you why, in January 2026, the distinction between paper and physical silver became the most important question in the entire precious metals market. By the end of this video, you will know exactly what kind of silver investor you are, and whether that is the kind you actually want to be. Let's start with the most basic question. What is paper silver? Paper silver is any financial product that gives you exposure to the silver price without giving you ownership of physical metal. It tracks silver. It moves with silver. But it is not silver. The most common forms of paper silver are ETFs like SLV and SIVR, futures contracts traded on COMEX, silver mining stocks, and silver streaming royalty companies. The appeal is obvious. Paper silver is convenient. You buy it through any brokerage account in seconds. There is no storage cost, no insurance cost, no shipping cost. You can sell it instantly during market hours. And the price follows silver almost perfectly in normal market conditions. For most investors in most situations, paper silver does exactly what it is supposed to do. But there are 3 specific situations where paper silver stops doing what most people think it does. And those situations are exactly the ones that tend to occur during financial crises, which is precisely when many people own silver in the first place. Let's talk about SLV first because it is by far the most widely owned silver product in the world. SLV, the iShares Silver Trust, is managed by BlackRock and is the world's largest silver ETF. According to Metalorix's March 2026 analysis, SLV holds physical silver bars that meet London Bullion Market Association good delivery standards. JPMorgan Chase Bank acts as the primary custodian, storing the silver in vaults in London and New York. For every share of SLV you own, there is a corresponding amount of physical silver sitting in a vault somewhere. In that sense, SLV is physically backed. That part is true. But here is where it gets complicated. When you buy SLV, you own shares of a trust, not silver. The SLV prospectus is explicit. Individual investors cannot request delivery of physical silver. Only what the prospectus calls authorized participants, large financial institutions like market makers and major banks, can create or redeem share baskets and interact directly with the physical silver. As MintBuilder's February 2026 analysis summarized it, when you own SLV, a chain of counterparties stands between you and your silver. Your brokerage holds your shares in a street name account. The depository trust company is the registered owner of most ETF shares. BlackRock manages the trust. JPMorgan holds the metal. Sub-custodians may hold some of that metal in other vaults. What this means in practice: if any link in that chain fails, brokerage bankruptcy, custodian fraud, regulatory freeze, exchange closure, your access to the silver is interrupted. The SLV prospectus itself acknowledges this, warning that the trust may suffer losses if the custodian's internal controls fail to detect theft, fraud, or unauthorized access. And because individual SLV investors are not direct parties to the custodian agreement, their claims against JPMorgan may be legally limited. There is also the fee erosion problem. SLV charges an annual expense ratio of 0.50%. That sounds small, but MintBuilder's analysis noted that over 10 years, SLV's fees consume approximately 5% of your investment. A 100-ounce silver bar purchased today still contains exactly 100 ounces in 2036. The same dollar amount in SLV would represent approximately 5% less silver by then, due to cumulative fee deductions. Your shares represent slightly less metal every single year. And then there is the crisis suspension risk. During the March 2020 COVID crash, several precious metals ETFs temporarily suspended new share creation, when physical silver became scarce. Gainesvillecoin's analysis confirmed this directly. What happens to the SLV price when share creation is suspended? It can trade at a significant premium or discount to its actual net asset value, meaning you could be buying or selling at a price that no longer reflects the true value of the underlying silver. This structural vulnerability was visible in 2020 and remains embedded in the product design. None of this means SLV is a scam. It is a legitimate, regulated financial product that serves a real purpose for traders and short-term investors who need silver price exposure with maximum liquidity. The question is whether it is the right product for someone who owns silver, because they are worried about financial system stress, because that is precisely the scenario where its structural limitations become most relevant. Now let's talk about PSLV, the Sprott Physical Silver Trust, because it occupies a genuinely different position in the paper-to-physical spectrum. PSLV is a closed-end trust that holds fully allocated physical silver. Fully allocated means every ounce of silver in the trust is specifically assigned and ring-fenced to the trust. It is not pooled with other holdings or lent out. According to Sprott's own F10EF filing with the SEC, the trust is designed to be a long-term holder of physical silver bullion and does not anticipate selling metal except to fund expenses. Here is the critical difference from SLV. PSLV allows physical redemption. Investors holding a minimum of 10,000 units, worth approximately $90,000 at current prices, can actually redeem their units for physical silver and take delivery of the real metal. This is not available to SLV holders at any level short of being an authorized participant. For investors who view silver as genuine crisis insurance, this distinction is meaningful. You have a legal path, however expensive and minimum heavy, to converting your paper claim into real metal. PSLV does charge a slightly higher fee at 0.57% versus SLV's 0.50%. It also trades as a closed-end trust, meaning it can trade at a premium or discount to its net asset value depending on market conditions. As of late 2025, PSLV was trading at a 3.69% discount to NAV, meaning you were paying less than the underlying silver was worth, which is actually advantageous for buyers, but it also means pricing is less predictable than SLV. In January 2026, something important happened in the ETF market that illustrated exactly why investors are increasingly distinguishing between these two products. Investing.com's January 2026 analysis noted that while SLV experienced significant outflows as investors took profits during the silver surge, PSLV and SIVR attracted capital inflows. The divergence suggests sophisticated investors were deliberately shifting from paper-backed structures toward products perceived to have stronger physical backing. Sprott simultaneously doubled its capital raise capacity to $2 billion, enough at then-current prices to acquire approximately 18 million ounces of physical silver. The institutional signal was clear. When the silver market gets stressed, smart money distinguishes between types of silver exposure. Now let's talk about physical silver. The real thing. When you buy a physical silver product, an American Silver Eagle coin, a 10-ounce bar, a 100-ounce bar from a major refiner, you own silver. Not a share of a trust that holds silver. Not a paper claim redeemable under specific conditions. The actual metal in your possession, accessible without involving any financial institution, any custodian, any counterparty, or any exchange. The practical advantages of physical silver are simple. Zero counterparty risk. No fees deducting from your holdings year after year. No legal question about what you own. No crisis suspension scenario. If JPMorgan fails, your silver bar is still a silver bar. If your brokerage goes bankrupt, your silver coins are still your silver coins. In the most extreme financial scenarios, the ones that make people want silver in the first place, physical metal is the only form of silver exposure that operates completely outside the financial system. Physical silver also has practical advantages most people don't think about. You can sell physical silver to any bullion dealer in the world. You can sell it privately. You can gift it or bequeath it without triggering the reporting requirements associated with securities accounts. In countries with currency controls or restrictions on asset transfers, physical metal can move in ways that digital financial assets cannot. But physical silver also has real costs and real limitations that most YouTube channels dramatically understate. Storage is not free. If you are holding meaningful quantities of silver at home, you need a safe, and safes that meet insurance requirements for precious metals are expensive. Professional vault storage at a deputable depository runs between 0.5% and 1.5% of value per year, not far off what you would pay in ETF fees, but with added insurance and security that is not discretionary. Selling physical silver involves dealer premiums. When you buy, you pay above spot price. When you sell, you receive below spot price. The spread can run anywhere from 3% to 10% depending on product type, quantity, and market conditions. That spread is a real cost that paper silver does not have in the same way. And physical silver is not liquid in the same way paper silver is. You cannot sell a silver bar at 2 a.m. on your phone during a market move. You have to transport it, authenticate it, and find a buyer willing to pay fair value. In volatile markets, that process takes time. For short-term traders, physical silver is the wrong tool. For long-term holders with a genuine conviction about financial system risk, it is the right one. Now let's be direct about taxes, because this affects every form of silver, and most investors get it wrong. Both SLV and PSLV are classified by the IRS as collectibles, not as regular securities. That means capital gains on both are taxed at a maximum federal rate of 28%, significantly higher than the 15% to 20% long-term capital gains rate that applies to stocks and most other investments. Physical silver held outside a retirement account is also taxed as a collectible at the same 28% maximum rate. There is no tax advantage to choosing ETF over physical or physical over ETF in a taxable account. The tax treatment is identical. Within an IRA, either a traditional IRA or a self-directed IRA that permits physical precious metals, both structures can grow tax-deferred or tax-free depending on account type. One important nuance. A silver IRA that holds physical metal in an IRS-approved depository is a legitimate and regulated structure. But the fees associated with silver IRA custodians are significantly higher than standard retirement account fees, typically including setup fees, annual maintenance fees, and storage fees that can total 1% to 2% of account value annually. Anyone considering a silver IRA should model those fees carefully before committing. So let's make the decision framework as simple as possible because this is money simplified, and simple is the point. If you are a short-term trader or want silver price exposure with maximum liquidity and minimum hassle, SLV or SIVR are the right tools. They track the silver price efficiently, they are cheap to hold in the short term, and they work exactly as advertised for their intended purpose. If you want silver exposure with stronger physical backing than SLV but still want the convenience of a brokerage account, PSLV is the better option. The fee is slightly higher, the liquidity is slightly lower, but the allocated structure and physical redemption option make it meaningfully more robust in stress scenarios. If you own silver because you are genuinely concerned about financial system risk, if silver is your insurance policy against the kind of extreme scenario where financial institutions fail and counterparty chains break, then physical silver is the only form of ownership that is actually insulated from those risks, because in that scenario, SLV's custodian chain is exactly the kind of thing that would be under stress. And the key insight from January 2026, when silver hit $120, crashed 31% in a single day, ETF suspended share creation, and physical metal in Shanghai traded at a 12% premium over COMEX paper prices, is that these distinctions stopped being theoretical. They became real. In a matter of days, the difference between owning paper silver and owning physical silver was the difference between holding an asset that repriced based on leveraged contract liquidations and holding an asset that Chinese industrial buyers were willing to pay $84 for, while New York paper said it was worth $75. The silver you can hold is the silver you actually own. Everything else is a claim. Claims are only as good as the counterparties behind them. Everything in this video is for educational purposes only. Money Simplified is not a licensed financial advisor, and nothing here constitutes financial advice. Before making any decisions about silver investments, ETFs, or physical bullion, please speak with a qualified financial professional who understands your specific situation. If Money Simplified helped you understand the difference between real and paper silver in a way that actually makes sense, hit that like button. Next video, we are breaking down the gold to silver ratio and what history says happens when it reaches the levels we are seeing right now. Subscribe so you do not miss it. See you in the next one.